Mike, 2025 was a fun one. We had AI developments, trade tensions, remember Liberation Day? We had the one big beautiful bill and a government shutdown for good measure. But as we put a ribbon on 2025, let's give the people what they really want. What are our themes going into 2026? Let's start with the Fed and inflation. We're preparing ourselves for a new look Fed in 2026, likely going to be a divided Fed, and they've got some stuff they need to work out.
We think a lot of companies still have not passed on the cost of tariffs to consumers through price increases. And so what's ultimately going to happen is as those companies continue to do that, core inflation is going to run above the Fed's target, we think, for all of 2026. But the disagreement comes in where if you were to look at core inflation X the impact of tariffs, it's a much more benign path. We actually think core inflation is going to hit the Fed's 2% target somewhere around February, or at least sometime during Q1 of 2026. So this is going to continue to drive disagreement amongst Fed officials on the future path of interest rates.
Yeah. So you got the interesting dynamics on the inflation side. Of course, the other side of the mandate, employment. Right. And with the AI developments, one of the concerns being that it's going to be hard to maintain this labor market. Jobs are going to be replaced by AI. Maybe not quite the case just yet.
Thus far, if any sector of the economy is going to be reducing headcount, reducing job openings, and more productively using AI, it's going to be tech. They created AI. They should be able to reap the benefits or be first movers from that respect. And if you look at the tech sector's share of total employment over time, you can see since ChatGPT was launched, it has flatlined and even headed down. And so we think throughout 2026, AI is going to continue to be an excuse for companies either to remove job openings or just do more with fewer employees. And that should happen in more and more sectors as we move through 2026. So we think demand for labor next year is still going to be low, and it's going to continue to create concerns from the Fed about weakness in the labor market.
Yeah. So inflation coming down, maybe around the Fed's target without the impact of those tariffs, some bubbling potential concerns on the labor market side, leaves us in a position where we still expect some Fed cuts coming down the pike here.
Yeah, we still think December or the Fed meeting this week will be a cut. It may be a hawkish cut. There may be a lot of division within the Federal Open Market Committee. But then as we move out into 2026, we think there will continue to be disagreement, but it should be easy for the FOMC to justify 2 more interest rate cuts, given the concerns about a slowdown in the labor market, as long as those interest rate cuts are seen as moving back to the long-run neutral rate, which we think is around 3%. So 2 more cuts, most likely happening after the new Fed chair steps in 2026, sometime in the late spring, early summertime period, is our base case, and the market has definitely moved towards that.
So that's the Fed, and important to note, right, on the labor market side, we're still not seeing the firing levels, getting us to a point where the labor market would be a point of concern just yet.
Yeah, and this is where our macroeconomic forecasts start to become more constructive. Thankfully, we haven't seen the firing, initial and continuing jobless claims well below recessionary levels by our estimation of what recessionary levels are, even through the government shutdown. So that's been the good news, the silver lining. That's exactly what equity investors want to see. And you take that good news, you combine it with, if we get 3 more Fed rate cuts, 18 months ago, we were talking about a 5.5% Fed funds rate, and now we're talking about 3% at the end of next year.
Yeah.
That move, that's a lot of stimulus.
Yeah.
In an economy that is holding together, sort of late cycle stimulus, we think that's going to be pretty productive for economic growth.
Yeah. Definitely a more stimulative environment from a monetary policy perspective. And then you pair that with the fiscal policy, right? We had the one big beautiful bill passed on July 4th. Around that time, we were talking about how this will be the most impactful, the most stimulative in the first half of 2026, right?
Yes, and the way that you'll feel that is through personal income tax refunds, especially for middle income households. They're proportionally supposed to benefit the most. We think 2026 will be a record year for refunds. $412 billion is our estimate. On a per household basis, that's $500 more per household next year than this year. And that's a decent amount of stimulus. That should reaccelerate economic growth next year. Hopefully, it does not spur additional inflation.
Right.
But we'll get into that a little later.
Yeah, absolutely. So that's kind of the macro backdrop, right? Stimulative monetary policy, stimulative fiscal policy, but getting into markets, and particularly the tech sector and AI, there's been a lot of consternation about spending levels and CapEx. And let's kind of revisit this picture here in terms of CapEx and what these companies need to do with that CapEx.
Yeah, we think the 7 hyperscalers, the consensus is that they're going to do about $7.2 trillion worth of CapEx over the next 10 years. That's a lot of money. Importantly, one person's CapEx is another person's revenues. So the beneficiaries of that CapEx spend should continue to do well. The concern in a lot of outlooks is, well, what if these CapEx plans don't become realized? What if this is a bubble and it bursts? And we've gone through this analysis. We think the amount of CapEx currently expected by the hyperscalers actually seems rational. In order to make that investment make sense, they probably only need to generate 6.7% annualized revenue growth over the next 10 years, which is below consensus and below what they've historically been able to generate. So we do not think that this CapEx spend is in a bubble. There's certainly going to be volatility around it, but if anything, we think it has room to continue or even grow as we move into 2026.
And so how could all of that CapEx spending actually impact economic growth in 2026?
It's definitely been a driver. If you look at the BEA's official statistics looking at GDP growth, you can see private fixed investment, AI-related investments, are worth about 0.9 percentage points of economic growth over the past 12 months. Total GDP growth, real GDP growth, was 2.1. So contributing almost half. That's a pretty significant driver. At this point, a lot of that private investment, the materials for it, the semiconductor chips and so on are being imported. So those imports detract from economic growth and it somewhat offsets. So the full impact of this CapEx, it's not really showing up in the GDP growth numbers.
Yeah.
Because if you take the 0.9 contribution from the private investment, but you lop off a half a percentage point from it being imported, it's really not a big deal. But this is still a lot of money that's being spent in the economy and a lot of private investment. And we think it'll continue to be a driver of company earnings and economic activity in 2026.
Yeah. And with that in mind, let's take a look at where the opportunities could lie within the global equity market. From just a distance from trend valuation standpoint, NASDAQ 100 continues to be relatively rich, pricing in a lot of those AI expectations, but still opportunities elsewhere.
Yeah, if you look at the winning asset class of this AI boom thus far, it's been the NASDAQ 100 type companies, the hyperscalers, NVIDIA, the Magnificent Seven. We're all talking about the same thing. As we sit here today, the expectations are very high. That basket of stocks is 90% above trend. That's the second most expensive in history. And these companies are spending $7.2 trillion. And who is going to reap the benefits of all that investment? Obviously, thus far, it's been companies like NVIDIA, but as the AI boom continues, it'll probably be more and more companies benefiting, and older technology companies that maybe have higher labor costs finding a way to harness the power of AI to increase margins. And so we think this creates an opportunity for a broader opportunity set of stocks to do well in 2026 and beyond. Value stocks are only 13% above trend, small values 14% below trend, foreign stocks are below trend. So there's room for them to catch up and give above trend returns. So we think that's a really attractive opportunity as we go into 2026. Diversification should be rewarded within the equity market more so in 2026 than it has been since 2023.
Yeah. And so we're talking about a lot of positive support mechanisms for the economy and for markets. What's, in our view, the biggest thing that could throw this off the rails, the biggest risk going into 2026?
Yeah, we've said, throughout 2025. The biggest risk in 2026 is too much of a good thing. The cumulative stimulative impact of those rate cuts that we've had over the past 18 months, plus fiscal stimulus, and perhaps concerns about the fiscal trajectory of the United States, combine and manifest themselves in rising longer-term Treasury yields. And we've seen in the past, when the 10-year Treasury yield moves swiftly above 4% towards 4.5% or 5%, that has really sapped risk appetite for stock investors. And it's created almost a mirror image drawdown or pullback in the equity market as equity investors sort of reassess the math here. There is risk of that type of a move as we go into 2026. We do think longer-term Treasury yields should be biased higher as long as we continue to avoid recession, which we think is likely. And also, as that's happening, valuations of stocks are somewhat expensive. So, you may have a little more room to fall. So
right.
That to us is the biggest risk to the equity market heading into 2026 that we will be monitoring very closely.
And that'll do it for the 2026 Outlook by SageView. If you have any questions or comments, please feel free to reach out.